It's Tuesday and we're getting technical and we're taking a look at the charts with our next guest, J.C. Peretz. He's the founder and president of Eagle Bay Capital. He's also editor of the technical analysis blog, allcharts.com. J.C., thanks for joining us this morning as we kick off September. Let's start with the indicator that, one of the indicators that you use. You know, it's one of the ones you always pick out of your toolbox and use a lot. What is it?
Well, something that we think is very important is the internals of the market. You know, at the end of the day, yeah, the S&P 500 is an index with a specific price, but let's remember what makes up the S&P 500. These are 500 stocks. So we want to look, we want to see beneath the surface and see what's really happening with these stocks. And on the new highs that the S&P 500 made into the beginning of August, there were less stocks that were in uptrends. So we defined an uptrend with stocks that are trading above their 200-day moving averages. So we want to look at the percentage of stocks that are trading above that level. And as prices were making new highs throughout the entire year, every single new high that the S&P made, there were new stocks participating. There were more and more stocks trading above their 200-day moving average, and that actually changed at the beginning of August, where we saw less so. So now we want to see where we are now. So yeah, we have that bearish divergence, but with the S&P 500 trading what? 4 or 5% above the June lows, there are actually just as many stocks trading above the 200-day as there were at those June lows. So in other words, although the headline is S&P 500 still 4 or 5% above the June lows, the internals of the market are actually just as bad now as they were then. So we take that as a negative.
We're looking at the S&P 500 here right now. We're looking at that 200-day moving average chart with the 500. So when you look at those, a bit of a deterioration underneath the headline, what does that say for the next couple of months for the 500?
Yeah, I think that I think you can take any strength as an opportunity to sell stocks, to lighten up for sure. Because remember, it's cliche and everything to say that this is a market of stocks and not necessarily a stock market, but it really is true, Francis. If there are less stocks participating and the internals of the market are weakening, then the index itself is sure to follow.
We're going to show a chart that you provided us with looking at the correlation between treasuries and equities. I'm seeing yields back up pretty substantially again here this morning. We're at 290, almost 290 on the U.S. Treasury. I like this chart because we were kind of walking hand in hand, equities and bonds, and there seems to have been a divergence. What does this tell you?
Yes, that's right. So over the longer term, the correlation between stocks and bonds is pretty negative. In other words, bonds go up, stocks go down, and that's been, you know, the trend over the last couple of years. And just recently, you know, with the whole worry about tapering and everything like that, you know, stocks started to trade with bonds. So as rates, you know, as rates started going up, that was bad for stocks and bonds. As rates went down, that was you know, that was good for stocks and bonds. And last Monday, around 2 o'clock, things started to change. And as equities rolled over in the afternoon, treasuries went out at the highs. And that, to us, was very significant, that change. And it wasn't just a one-day wonder. That followed through for the rest of the week. In fact, we're actually seeing it again today with stocks up and bonds down. So I think that new negative correlation, I think, is here to stay and something we should pay attention to.
And paying attention to it just on the bond side, we have a picture of the TLT as the 20, I think it's the Barclays 20-year bond index ETF. You a buyer or a seller of this one? A lot of people are sellers of bonds right now, of course.
Nobody likes bonds. Nobody does. I do. So we want to look at sentiment. And last time there were this few bulls in treasury bonds was actually at the beginning of 2011. And TLT, which I like to use as a good gauge of treasury bonds, it's a little bit of a longer end bond. Treasuries rallied 40% off of those lows at the beginning of 2011. And we haven't had this few bulls ever since. So with nobody liking bonds and everybody hating them, I think that the unwind of that sentiment could potentially be a nice catalyst to send bonds soaring. I think what we want to look at is in yields, in the 10-year yields, we want to look at that 2.7%. If that breaks below 2.7, I think you're going to get, you know, as you like to call it, a rip-your-face-off rally in bonds if yields can get below those levels.
And that's a big if, of course, because right now we're closer to 290, as I said a minute ago. One of the interesting dynamics out there recently has been the U.S. dollar, whether you look at a trade-weighted basis, you look at it relative to the euro or the pound or even our Canadian dollar. What is it telling you vis-a-vis commodities? Because usually, and we're looking at a chart again that you provided us, usually the U.S. dollar goes up, commodity prices go down.
Sure. Well, this is, as far as we're concerned, one of the most reliable negative correlations in the intermarket world. That relationship between U.S. dollars and commodities. Because remember, these commodities are priced in dollars. So if the denominator in a fraction is strengthening, then the value of that fraction should therefore deteriorate. And that's what we see time and time again. And the U.S. dollar has been in a solid uptrend from the beginning of 2011. In fact, the Treasury bond rally that we were just describing actually coincided with a rally in the U.S. dollar. So it's not, it shouldn't come as to a surprise if bonds start rallying from here, and so do U.S. dollars. Because dollars have really been in an uptrend since 2011. We're at that uptrend line right now. And as long as the dollar index is above 80, it looks like U.S. dollars are heading higher. And that's very negative for commodity prices. And the way we look at it is commodities and emerging markets are very, very closely tied together. So if dollars are rallying and commodities are selling off, that's bad for emerging markets. And I find it very hard to believe that U.S. stocks are going to do well in an environment where emerging markets are struggling.
There's a chart making the rounds in the blogosphere of gold and Apple and how interestingly correlated they have been here over the last year or so. Makes no sense at all, but gold and the U.S. dollar makes sense. What do you think of gold right here? Are you worried about commodities as that U.S. dollar rises? Are you worried about gold?
Well, remember that gold is actually a very small percentage of the CRB index. And not a lot of people know that. The CRB consists of what, 19 commodities? Oil and energy really is a huge, huge part of that index. And gold is actually very, very small. And oftentimes kind of trades in a world of its own because of its safe haven status and its currency status, if you will. So we can actually kind of take that out of the equation. Although strength in dollars, I have to believe that gold is going to have a tough time rallying hard from that level. I think gold had a pretty serious breakdown a couple of months ago, and I think that if it stands a chance to really get back into this bull market that we've seen for the last, 14 some odd years or whatever the case may be, I think that some time is really necessary before we can get a really big leg. We just saw a pretty big bounce off of those lows, big bounce. So I think some time is necessary.
Okay, JC, yeah, it was about 18% from the lows. Thanks for joining us this morning.
Sure, thanks for having me.
JC Peretz is founder and president of Eagle Bay Capital. He's also editor of the technical analysis blog, allstarcharts.com.